Welcome to Tim and Julie Harris Superstar Interviews. We're joined today by Sean O'Toole from PropertyRadar to discuss their rebranding from ForeclosureRadar.com, their new upmarket strategy for the recovery, and how his organization has adapted to the changing real estate marketplace. Now to your host, Tim Harris.
Today we have a very special co-host, someone who a lot of you guys are familiar with from the world of distressed real estate, someone who is very well known amongst, I would say, the ranks of the real estate experts, the true experts. He's been featured on 60 Minutes and is often the go-to person for interviews when it comes to housing and comes to investing. It comes to anything that has to do with residential real estate. Welcome to the call, Mr. Sean O'Toole.
Hi, Tim. Thanks for having me.
Was that a good enough introduction?
That was awesome.
Yeah, I was going to read your bio. I see you've been involved in a lot of other things since the last time we've interviewed you. Anything in particular you want to bring up that I wouldn't know about that would benefit the listeners?
Oh, well, just that I was an active investor. I'm a real estate broker, and kind of rode the foreclosure wave and helped folks out there. So, but no, you covered it well.
Well, and a lot of our students have been working directly with you guys, getting access to notice of defaults and all that great information. So I've always appreciated you guys for your ability to get really amazing information. So I've got, I have 6 really specific questions that I wrote down, and I think these are all within your wheelhouse. So listeners, we're not going to probably take a break today because Sean always has a lot of great stuff to talk about. And Sean, the first question that I wrote down, are we in a housing bubble again? Or is it an asset bubble like a lot of the talking heads on CNBC like to warn us about?
Well, I'd argue we didn't have a housing bubble last time. We had a credit bubble. And this time I think, yes, we have a Fed-induced asset bubble. The good news is I love hearing everybody talk about, when is housing going to recover? Housing recovering to 2006 prices would be about the worst thing that could possibly happen because for incomes to support that, incomes would have to double from where they are now. So I think we're, a little higher than we should be. One of the things we look at really closely is the affordability. We don't use kind of the standard affordability indexes because I think they're a little skewed. But we think it's a little high in some areas right now, but not nearly as bad it was in 2006, 2007.
So you just said a couple things, actually about 10 things that I could drill down on. So one thing in particular, you said something along the lines of, you're hoping the housing doesn't recover in terms of values. So there's been a lot of people that have been saying that, and for the most part, the country won't be back to those sort of peak values. I'm sure you've heard different things and probably have your own better informed opinion than what I'm about to say. But for the most part, people are guessing that housing won't be back until like 2020. Pick your date, right? 10 years in the future. And you're suggesting that would actually be did I hear you correctly? That would actually be a bad thing for the industry or for the overall economy. Help me understand that.
So, one of the things that I think is really just tough is kind of the whole notion of value. So values as compared to incomes got way out of hand in 2006 due to loose credit. If that happens again, we're likely going to see the same aftermath that we saw last time. So if you look at housing in relation to incomes, to really get back to those housing price levels, we need incomes to double. That can happen one of 2 ways. One is economic growth, which would be awesome, but hasn't happened in a long, long time, that then drives wage growth. Instead, we're having productivity gains through computers that are actually driving wage declines. So I don't see it happening that way. The other way it can happen is through inflation, and that's where inflation is a secret government tax where they slowly just charge you more for everything and then lie about what inflation really is so that they can pay out less on other things and deflate their own debt away. So, we're going to continue to have inflation and, homes are a fantastic hedge against inflation, and it's the primary reason in my mind to own a home. is as an inflation hedge. And we will see prices go back to 2006 levels due to inflation. We have relatively low inflation right now, though, so I don't expect that'll happen, or that should happen quickly.
So inflation, again, will make real estate it'll make it more expensive. It'll hypothetically make folks that are underwater on their mortgages still, it'll make those folks maybe be even and maybe have some equity on paper versus now. I mean, those are all the benefits.
Absolutely. Over time, it deflates debt away. Yep.
Great. So tell me about the downside of inflation. And the second question I'm going to ask you is, do you think inflation is happening at a rate that's not being correctly reported right now? And this is something I pay attention a lot to, because frankly I don't completely understand it. I don't think anyone really does. But, you know, the way the government reports the inflation and the way that modern everyday people going to the grocery store saying, hey, why is the gallon of milk now $6? So what's going on? Is there inflation or isn't there inflation? And what is the downside to the real estate industry, assuming that inflation does kick in, which would be a natural reaction to all this ridiculous Fed, you know, which maybe the government didn't have an alternative, but all the printing of the money since forever, all these QEs and different versions of it, that's obviously going to cause, well, it should cause inflation. So answering those two questions, anything come to mind?
Yeah, I mean, one thing for folks who want to dive into this, I recommend John Williams' Shadow Stats website, shadowstats.com. What he does is he tracks inflation the way our government used to track inflation. And over the years, they've kind of slowly manipulated it to remove things like, you know, housing and food and fuel, and not all of it, but, you know, some of it enough to mute what inflation is being reported as. So we keep reporting that there's low inflation. But if you add back in some of these other things, as he reports, you know, inflation's actually quite a bit higher. So, yeah, I do think inflation's higher than is being reported, at least in terms of how it hits our pocketbooks. And, you know, inflation makes us all a little poorer every day. It hurts savers. And, you know, if we have a certain income and there's inflation, then we can afford less, you know, as that inflation occurs. So it's definitely a tax. You know, and stealing from savers and stealing from hardworking people and the rest.
So a lot of folks in the industry, in the real estate industry, say things that I don't quite understand. They're praying for inflation. They're hoping that there's an inflationary time where basically, right. So let's talk about what happens. You know, history repeats itself. 1970s had high inflation, Jimmy Carter era. Interest rates went through the roof. Housing certainly wasn't strong in that time. So share with the listeners sort of the types of things that can happen when there is inflation, when it does enter its, you know, when it's clearly something that's a headwind to the economy, clearly a headwind to housing. You know, all these people that are saying inflation is good for real estate, what's the flip side to that coin?
Well, I mean, it's good from real estate if you think the value of real estate is the price going up, right? But as the price goes up, so do your property taxes and the rest. This whole notion that just higher prices is you know, a good thing, I think, is something that should be questioned more than it is. It's certainly a good thing, you know, for realtors at the end of the day, because higher prices mean a higher commission check. Now, if that happens just because of inflation, all your costs went up and all you're doing is, you know, treading water. So it really doesn't matter at the end of the day. You know, so yeah, I lost track of your question. Sorry.
Well, I mean, so inflation would cause, like you said, property taxes to go up, but all the other expenses in your life also increase. So even if you're you're in, right.
Yeah, you're just treading water.
Yeah, you're just, you know, putting it from one pocket to the other. But on paper, from a stage, it certainly sounds exciting to say, well, if inflation kicks in, home values go up, and hey, your commissions will go up too. Yay, everyone celebrates. But then, by the way, there'll be
big benefit is that your debt stays fixed. So as you have inflation, your debt gets smaller, right? And so this is one of the key advantages to home ownership, right? So let's say you buy a home today, and let's say it's $100 more a month to own a home than to rent a home, right? Well, next year it's probably going to be $50 more, and the year after that it's going to be the same, and the year after that it's going to be $50 less, because rent's going to keep going up with inflation. right? But your mortgage payment, if you get a fixed 30-year mortgage, is locked in for 30 years. And so basically it makes you a little richer every year versus somebody who's renting, right? Because you've locked in your rent for the next 30 years. Now, it only works if you don't move, every 2 years, but it works pretty well. And if you have that kind of plan in mind, you can retire with a kind of a forced savings account, retire owning your home free and clear and be in pretty good shape, and live a lot better than the folks who treated their house as a piggy bank.
Yeah, and I mean, the going rates right now are something like 4.35%, and if you can get a 30-year fixed at 4.35%, and inflation creeps up to be at that interest rate or higher, basically the inflation of the house is more than covering your costs, assuming the property taxes don't go through the roof. So yeah,
even if the interest rate's 2%, it compounds, so it's still going to be far more than the interest rate over the long term.
Exactly. So, are we in a real estate recovery? I'm going to use this and I'm going to put it in quotes. Are we in a real estate recovery, Sean?
Yeah, no, I don't think there's any question that's not true, right? So the recovery that we have had is through an awful lot of stimulus. They pretty much stopped the foreclosure process. The only loans being made are, basically a gift of the Fed, right? There isn't really private money making home loans, and interest rates are being held artificially low by the Federal Reserve. I mean, it's no question the most massive housing stimulus that we've had in the history of the United States. And it certainly, caused prices to come up a bit. It certainly saved a lot of banks, by inflating those prices artificially as it may be, from a lot worse than it would have been. And I think that's the primary reason behind it.
So tell me about the effect of hedge funds. And there's been a lot of different theories. I remember, Sean, last time we actually saw you in person, the hedge funds, the conversation was, well, these hedge funds want to buy these properties and turn them into long-time rentals and have the returns be based on, the positive cash flow and all that sort of thing. Then I noticed that their pitch to their prospective investors changed now to this long-term, even thought of a new acronym for it, which I don't actually remember, but now it's just basically they're buying these or getting more investors to invest with them to buy more single families, so I'm sure that's kind of tapering off to the idea that they're going to be worth more because of inflation. So investors, how much, especially the big guys from Wall Street, how big of a market is that still today, and do you anticipate those guys continuing to buy, say, for the next 12 to 24 months?
Yeah, so like in California where we have pretty deep data, at the peak they bought about 6.5% of the properties, 6.5% of the properties for sale in that given month. So right now they're more around 3.5% of the market, and even through, kind of the end of 2011, they were less than 3% of the market. So for all the talk about them, they were never really that big a piece of the total market. Now, a lot of people are also worried that they're going to start unloading their stuff, and we track that as well. And actually sales by these LLCs, LPs, and the rest have been down pretty much consistently the last year. So not a huge piece of the market. Definitely an interesting story, but it had more impact in some places like Sacramento and Riverside where they helped push prices up. But that's because prices were fundamentally too low. The returns on investment were really high there, and they needed to come back up to reasonable levels.
In your opinion, what would cause them to want to start selling?
I think the primary thing that they're going to face is, learning how to manage all these properties and keep them full and the rest. But as we continue not to build new inventory and as we continue to have natural population growth, I think they're going to figure that out, and it's actually going to be a pretty decent business. And, to the degree that they're able to put together these, there is a term for it, like collateralized debt obligation, but for a residential loan.
Right.
And I'm spacing on it too. Is they're able to, put together these deals and sell that debt off for these long-term returns, they've had pretty nice exits, helped by the fact that prices increased a lot over the last, couple of years. So, I think it was a really good business for them to get into and pursue. As prices are now slowing down, I think we'll see less activity from them.
Well, we're going to talk about that.
And I don't think there'll ever be major sellers because, they understand, kind of like the reason China doesn't dump, their dollar assets. They understand as soon as they start dumping their dollar assets, the rest of their assets will all go down in value, so they really can't.
So the next question I wrote down, and this is something I know you obviously are an expert at, percent of underwater homeowners. So if we add in the number of people that are underwater by, a significant margin and those that are near underwater, in other words, if they were to sell their house, they basically would be underwater because of the selling fees and whatnot. What is the best number out there that you're seeing? What would you? I heard 10 million. I've heard 18 million. I've heard 6 million. What do you think the actual number is?
Yeah, nationally it's a little tough. I don't have national data. There's a lot of issues with putting together those equity estimates. Just a little bit of background, right? So for anybody who's putting out that stats, and we put out stats for that for California, it's based on two numbers. The first is the estimated value, or an AVM, which Zillow made popular with the Zestimate, right? So it's a computerized model of what the house is worth. On an individual house, it can vary quite a bit, but typically for a market as a whole, it's relatively accurate. Then the next thing that they're doing is they're modeling what the total open debt is, and that could be problematic too. For example, if somebody has a home equity line of credit with a zero balance, there's no way to know that it has a zero balance. So you're looking at, the total dollars kind of due. So first understand that all these estimates are based on, kind of those two figures. And that's why you get this wide range of that, kind of 6 to 10 million, as you've said. We're basically putting the number in California at about 1.2 million right now that are underwater, so their house is worth more. And probably another 200,000 or 300,000 that don't have enough equity to sell. So about 1.5 million homes, which is 17%, 18% of the homes in California.
So Sean, it's Julie.
Go ahead, Julie. I'm sorry.
Break in here. I was wondering.
Hi, Julie.
Hi. It's always good to hear your voice again. You spend a lot of time studying this stuff, obviously. What do you predict the headwinds to be moving forward over the next 6 to 12 months?
Well, clearly prices have gotten a little too high, so we're seeing that come around in slower sales. Really we've seen the slowest sales that we've seen since 2007, and it's kind of a similar drop-off in sales activity that we saw in 2005 that tipped me off to get out of the market. Now, the other thing that tipped me off to get out of the market was how overvalued everything was, and we're not in as bad a shape now, so I'm not as concerned now as I was in 2005. But whenever prices get ahead of the market, sellers don't instantly just correct. Instead, sellers stay with the high prices and sales slow down, and that's the situation we find ourselves in right now. But with still relatively low inventory and no external, pressure events like, resetting arms or things like that, I think we could stay in this kind of situation for a while. I don't see sellers going, well, geez, I really need to lower my price. I'm not seeing major increases in price reductions and the rest. But I think we've kind of hit probably a plateau for a while where we stay at a little bit of inflated prices with slower sales. Not necessarily the best news, but it's better than a big decline for sure. Which means that those people that are still underwater are probably really stuck there, right? There are folks with 100% financing in 2006 that there's just no way out for them other than to do a short sale or an REO. A lot of agents have abandoned short sales, and, that 1.5 million just in California still need that help.
what do you think would cause the market to adjust down in a significant way? Is there anything right now that if you were thinking about, well, if this happens, I mean, obviously there's but the black swan events, the worst case scenario type things. But is there anything you're seeing, sort of a known potential issue that could cause housing to actually take a significant step back?
No, not right now. I can make lots of logical arguments by perhaps why there should, but these things are emotional as well as logical, and right now the overall psychology of the market, I don't see it turning down unless there's some sort of black swan event. The Fed loses control of interest rates, stock market crashes, and people panic, or some kind of major unforeseeable thing. As if you read the Black Swan, Taleb's book, of course his whole point is that these unforeseen things do happen, and that the one thing we should expect is the unexpected. So while I can't see anything that's going to cause it, I expect something at some point.
So is there one thing in the industry right now that you wish folks, on the residential side were paying closer attention to? Is there one, why aren't people really focused on this? This is a potential issue, or this is a potential opportunity. You mentioned short sales, obviously, in California. I did the math. It's easy enough. 1.5 million folks that are still great candidates for short sales. Is there anything else in the industry on a whole that we all need to be paying attention to from your perspective that we're not?
I think we really need to have a better national discussion about what lending should look like long term, right? Because there's all this talk about shutting down Fannie and Freddie, but there's no real viable replacement for that. We all talk about how interest rates are artificially low, but what should they be, and how do we achieve that? Should lenders be forced to kind of lend at any value? There's a story today in DS News about how some lenders are getting a little concerned about lending at current valuations, just because it is getting a little bit high. So, those are conversations that aren't happening in a sufficient, kind of long-term, what do we want the housing market to look like 10 years from now sort of way. And I think there's very little leadership there, including from NAR.
Do you have any opinion about the Mortgage Debt Relief Act and the fact that, here we are in July and the Senate was supposed to approve its continuation for another 24 months, hasn't seemed to happen yet? I'm being told, I'm sure you are too, that it's supposedly going to happen. But if that doesn't happen, do you think it matters?
I mean, the good news is that, California got some clarifications, and there's some little complications in this, so you can't just go off it, but in short sale in California, it's not considered forgiven debt because it's non-recourse debt in most cases. There's some exceptions. So, like in California, we've pretty much skirted the bullet, and there isn't a problem with doing short sales here. That's not true in other states that don't treat that, as non-recourse debt. So that's something you really kind of have to look at a state-by-state level to say, hey, in the state that I'm at, is this debt non-recourse debt, and therefore, basically you need to work with an accountant or a tax attorney to determine the right situation for your clients. But in a lot of cases, there's a lot of non-recourse laws around the nation, and that debt may not be recourse, and if so, there's no forgiven debt tax issues. And
have you heard of
I think that's also hurt the this effort to get this law pushed through, because there's so many cases where it's it doesn't matter.
Right. So have you heard of any organized, grand scale servicers that have been pursuing deficiency judgments in the states that it's allowed?
No, really haven't. You got to keep in mind, though, the window on that is relatively long. I actually knew a guy in the early 2000s that bought up lots of second mortgages that hadn't been collected on for years. And after housing started booming kind of in the early 2000s, started going back and collecting on that when people once again had equity. So, it's I think the banks realize that, going after folks right now for that stuff would be politically untenable, and so I don't see them doing it. But at some point, do they sell those rights off and does somebody else go do it? And the banks go, oh, geez, sorry, or something. But the banks have been treading pretty carefully. I mean, they've gotten this fabulous deal from the Fed where the Fed has kept interest rates really low so that they can steal money from savers, right? Charge more fees and all the rest, be more profitable than they've been in years, with pretty much the only quid pro quo being that they, kind of turn the other shoulder on the foreclosure losses.
Yeah, it is pretty nuts. I agree. And I haven't heard of anything either, by the way, and we pay pretty close attention to it. I haven't heard of any sort of widespread, did you hear this is happening type thing? And, so who knows what's going to happen in the future. I suppose what you said could obviously happen, but I imagine it'll be on a, obviously, state-by-state, case-by-case basis. Dust off your crystal ball. Go ahead, I'm sorry.
Thing that most people don't realize, right, is that they read about all these attorney general settlements and other things that the banks are having to pay and, billions and billions of dollars. And all of that billions and billions of dollars has been funded by the Federal Reserve keeping interest rates artificially low so that banks can steal from savers. It's a wealth transfer.
Yeah. Well, it totally is. And, it's the middle class really that are suffering. And a lot of folks don't realize that they're essentially not getting ahead, that they're actually falling behind. And that's, how long that will last before, who knows what's going to happen as far as, the economy, people's mindset about willing to eat. How bad does it have to become? How much does the gallon of milk have to be? How big does the inequality have to actually, before people start reacting? Who knows? Maybe never is the answer because they're so busy paying off the debt that they have, or trying to keep level in the underwater home. I don't know. So dust off your crystal ball. Market predictions for the next 6 months and opportunities for agents. So if you could kind of gear your answer towards, if you talk to agents all the time. Obviously, you deal with a lot of investors. I'm sure being asked to speak in a lot of different venues. So you're in front of potentially thousands of agents right now. They're wanting to know what the next 6 months, what predictions that might happen, and also gear your predictions towards where they can take advantage of whatever the opportunity is.
Yeah, good. So unfortunately, I've been predicting now for a while, probably flat prices and declining sales volume. So I think that's, largely where we'll end up year over year at the end of the year here. I'm kind of hopeful actually that we don't see prices go way up, because that means we're back in bubble territory and at some risk. And I also hope they don't go way down, because that'll reintroduce some problems for the folks that, are just finally coming into some equity again. So I'm kind of hoping for flat more than a prediction. And then sales volumes, I think, we have less affordability, and so there's going to be fewer homes sold. And we pulled some demand forward. So that's kind of the big picture there. In terms of, opportunities for agents, reaching out to those underwater folks. We've got a lot of folks that did loan mods in 2008, 2009, and even 2010 that did not get any principal balance reductions, right? So I know of a house in Antioch where they got a loan mod that took a $900,000 loan, took the payment to $1,800 a month, 2% interest only. And that house today is still worth $500,000. And that $900,000 loan is still outstanding, and they're running up against the end of their 5 years, where that payment's supposed to reset to, I think, $6,500 a month from $1,800 a month. So, Now, I think the bank will probably modify again and let them continue to do maybe not 1,800, but something versus foreclosing, because that's easier for the banks at this point. But that fear of that impending issue, is definitely something that might bring that person to the table, to sell and do a short sale. So I do think short sales are still out there. The other thing is, just kind of getting back to basics, basic farming. We've got better tools than ever in terms of really selecting your market, making sure you're working the market. Yeah.
Go ahead.
Yeah, a lot of folks go into real estate and they pick the market that happens to be around them, or that the manager at the office they went to work for said they should focus on, or whatever. Right. But they've never done any analysis of that. And if you're working a market, you should know, what the total commission potential is in that market, who your competitors are, and who the customers are within that market, right? How many are underwater? How many are in foreclosure? What's the average, home size? Et cetera. These are the things that, as we went from foreclosure radar to property radar, we really got focused on, helping our customers with. Then, once you really have that market, starting to do, kind of the marketing automation to that market where you're reaching out to those same people, forget the lists from the title company that are out of date the minute that you get them. You need an online database that's constantly updating who the owner of each property in your market is, et cetera, and so that you're consistently advertising to these folks, but with the name of the current owner, and so that, every change of ownership is reflected in your database as you're going. And, that basic farming still works, especially for seller leads. You can buy buyer leads from, Zillow or Trulia. They've been pretty effective about disintermediating that. But they really are completely ineffective in helping you find sellers. And,
you bring up
really the place
you bring up an interest,
to focus.
Just so I can understand, Sean, what you're able to do is because you guys have such an incredible collection of different data feeds. You're able to, in most markets, I don't know how, are you in every state now, or what states are you working in? Yeah, so PropertyRadar, our new product, has been just in California. On Friday, it's going to launch into Arizona, Nevada, Oregon, and Washington, and then we're going to keep marching on from there. So someone could subscribe to your service, and I see that the base level subscription is $39 a month. And then by doing so, they'll get access to a very deep well of information about a particular, geographic area, or just they can use that information for doing CMAs. Well, the entire 5 states, actually, they get all of it, yeah. Right. So I'm listening, and I'm thinking as, a former agent, I'm thinking, okay, well, this would be an incredible farming tool, like you said, because you could take a geographic area. First of all, I like what you said. You could actually choose a geographic area that is most viable going forward, because you can actually look at, we always tell agents never try to break into a farm where there's maybe a dominant 1 or 2 or 3 agents, because you're just going to get their breadcrumbs. But you're saying, focus in on an area where there's going to be a lot of opportunity, because maybe the homes are just starting to turn over again, or a lot of agents will do just one postcard to a whole geographic area. Well, doesn't it make more sense to focus on the people that are most likely to move, and you can get that information from Property Radar by drilling down and finding the folks that, statistically are going to move because they've been there long enough, because we know they're of a certain age, so their kids have left that. I mean, there's certain trends that you can kind of leverage so that you can more target your efforts, maybe go knock on their doors. So this type of data, we've got about 100 different criteria that you can use there. If you want to focus in on horse properties in, the Central Valley, you can do that. So, it requires still some local knowledge, right? We're an experts professionals tool. So if you want to do horse properties, you have to know that in this county, the horse property has to be a half acre or more, and you have to put that criteria in. But you can do that.
And, and so really finding that farm where you can create your own niche, there isn't somebody dominating, or whoever is dominating you feel like you can effectively compete against. That's definitely step one. And then two, just consistently reaching out to those people, keeping that database up to date, paying for leads or even getting leads for free from a title company that are instantly out of date the minute that you get them, right? You won't, because marketing's not a one-time event. It's not like you get the lead, you send the thing, and you get a bunch of business. You build relationships over time. And to do that, you need leads that stay updated and tell you about when ownership changes or when people take out new loans or they go into foreclosure and all that stuff.
We're getting a lot of feedback from students, and we have been for probably about a year, that the whole buying buyer leads thing is basically, it's come and gone to the extent that the quality of the buyer leads has gone down. Obviously, Zillow has got, 50,000 users now paying an average of whatever they're paying, and now they're diluting the leads even more by, doing this deal where agents can, they're selling space on the agent's ads to lenders, and the lenders are paying for half. I'm sure you're familiar with all of this.
Yeah.
The nice thing about chasing down seller leads is the competition is usually, you guys chase the buyer leads because generally speaking, it requires less skill, but the money's always going to be on the listing side. I mean, there's no secret that the richest of the rich agents are always listing agents, and that'll always be true because of the fact that listing agents treat the business more like a business. They use information like what Sean's talking about. So you get this information and you understand your market backwards and forwards. When you go to talk to a seller, that's where your confidence comes from. That's where you can look in the seller in the eye, and you're not just having to worry about differentiating yourself, from the other agents they might be interviewing. The sheer volume of data and your depth of understanding of their market, that is what's going to, really ultimately make you different in their eyes, because you truly are an expert, not just someone who decided to spend $400 and call themselves an expert. So,
even if you want buyer's leads, I'd argue that public records, again, provide a great opportunity for buyer leads, right? Especially if you want to do first-time buyers, you can search for properties that are absentee owners. You won't get the name of the tenant, but you can direct mail or knock on doors of all the rentals in your area. Letting folks know that you help specialize in first-time buyers or people that had foreclosure. A lot of the renters are now folks that had foreclosures 3, 4, 5 years ago that can come back and buy again now. And so advertising to those absentee owner properties to the current tenant at those properties is a great place to find buyer leads as well.
That is actually an excellent point, because a lot of agents will do is they'll only mail to the tax record and just skip the tenant altogether. And the fact is the tenant's just as viable as a potential client as the seller of that rental property. I mean, that's a great point. So, guys, the bottom line here is there's opportunity everywhere, and especially in a shifting market like this. Expired listings later this year, I don't know if you track that data, Sean, but they're already starting to skyrocket. Obviously, longer days in the market caught a lot of agents, unprepared. They weren't pricing their inventory correctly in the spring. As we go through August and September, the expired rate across the country is going to, it's going to be incredible for those agents who are, on the ball, knowing how to go after expired listings. Combine that with Sean's products, PropertyRadar products. I mean, come on, guys, you can't go wrong with this. So, Sean, anything else you'd like to say to the readers, maybe our listeners, maybe a question I should have asked that I didn't?
Boy, we covered a lot. Definitely here and ready to help however we can. We love. We just love digging through the public records data, which is messy, ugly, bad data, but it's full of opportunities. And that's kind of our mission in life, is to expose those to folks. You mentioned that our pricing starts at $39. I will mention that if you're a CAR or even an NAR member and have a NERDS number, you can get a 10% discount. You can also get another 20% by prepaying for a year. So it actually gets it down to as low as $27.50 or something.
Right, $27.30 actually at your website. Yeah.
Good.
Yeah.
So that's true as well. So other from that, thanks for having me.
Sure, it's been my pleasure always, Sean. I always have to write my questions out ahead of time and really be paying attention with at least 2 cups of coffee in me before I start talking to you, because I got to be on the ball. But I appreciate that. So everyone, listen, reach out to Sean. Go to their website. It's Sean. Your web address is
PropertyRadar.com.
Right. Go to PropertyRadar.com and explore the information that he has available to you, and really consider enrolling and buying his product. I mean, guys, it's phenomenal. A lot of you have used Sean's previous product, Foreclosure Radar. That was one of the favorite tools that we always suggested, those of you who are aggressively pursuing short sales, that you subscribe to. Saying the same thing now for Property Radar, so definitely jump on board with that. Mr. O'Toole, thank you very much for your time today. I really appreciate it.
Tim, Julie, thanks, guys.
Have a great day. Thanks, everyone.
Take
Talk
care.
to you tomorrow.
Bye-bye.